Friends, if you receive Social Security, there is one number you absolutely need to know before the next tax season because it can decide whether none of your Social Security is taxed, whether part of it is taxed, or whether up to 85% of your benefits become taxable income. And let me say something right at the beginning because this confuses people every year. When you hear up to 85% of Social Security can be taxed, that does not mean the IRS takes 85% of your check. It means that up to 85% of your benefit may be included in your taxable income, depending on your overall income picture. That distinction matters, and today I am going to explain exactly how it works, the key thresholds every retiree needs to know, the number you need to check, and how to avoid the kind of surprise tax bill that ruins a retirement budget. If you are new here, subscribe now, because this channel is all about taking these confusing government rules and turning them into plain English. Taxes, Social Security, Medicare, deposit rules, deadlines, benefit changes. If it affects your money, I break it down here. Now let us start with the most important idea in this entire video. The IRS does not decide whether your Social Security is taxable based on your age. It does not decide based on whether you are retired enough, and it does not decide based on one simple line from your Social Security statement. The IRS looks at something often called combined income. That is the number every senior must check. Your combined income is generally your adjusted gross income plus non-taxable interest plus 1/2 of your Social Security benefits. That is the formula that controls whether your Social Security remains fully tax-free for federal purposes, becomes partially taxable, or becomes up to 85% taxable. So if you only remember one thing from this video, remember this. Check your combined income, not just the size of your Social Security check. Now here are the basic IRS thresholds. If you file as single and your combined income is below $25,000, your Social Security is generally not federally taxable. If you file as single and your combined income is between $25,000 and $34,000, up to 50% of your benefits may be taxable. If you file as single and your combined income is above $34,000, up to 85% of your benefits may be taxable. If you are married filing jointly and your combined income is below $32,000, your Social Security is generally not federally taxable. If your combined income is between $32,000 and $44,000, up to 50% of your benefits may be taxable. And if your combined income is above $44,000, up to 85% of your benefits may be taxable. This is where a huge number of retirees get caught. They think, I only get $2,000 a month from Social Security, so I must be safe. But Social Security is only part of the picture. Once you add pension income, IRA withdrawals, wages from part-time work, rental income, interest, dividends, and even tax-exempt interest, your combined income can rise quickly. That is why check number one is this. Estimate your combined income before the tax bill arrives. Do not wait until April to discover that the IRS treated a large portion of your Social Security as taxable. Make a simple estimate. Look at your adjusted gross income from other sources. Add any tax-exempt interest. Then add 1/2 of your annual Social Security benefits. If that number pushes you over one of the thresholds I just mentioned, you know there is a tax issue to plan for. Check number two. Understand the difference between taxable and taxed at 85%. This sounds obvious, but it causes panic every year. If up to 85% of your Social Security becomes taxable, it simply means that portion is included in your taxable income and taxed at your normal income tax rate. It does not mean the government takes 85% of your benefit away. The difference is huge. For example, if you receive $24,000 a year in Social Security and the formula says 85% is taxable, that means up to $20,400 is included in your taxable income calculation. The actual tax you owe depends on your total income, deductions, filing status, and tax bracket. That is why you should never hear the phrase 85% taxable and assume disaster without doing the math. Check number three. Review what is pushing your combined income up. For many retirees, the main culprits are not Social Security itself. The main culprits are withdrawals from traditional IRAs and 401ks, pensions, and part-time work. Some people retire with the impression that once wages stop, tax problems disappear. Then required distributions begin, or they take a large withdrawal to pay for a car, home repairs, or family help, and suddenly their tax picture changes. Other people sell investments at a gain, convert part of a traditional IRA to a Roth IRA, or continue consulting work in retirement. Each of those moves can affect the taxability of benefits. So ask yourself, is my Social Security being taxed because of my benefit amount or because of the other income sitting around it? That question matters because it changes what you can do next. Check number 4. If you know your benefits will be taxable, decide whether you should have federal tax withheld now instead of being surprised later. Many retirees prefer to avoid a large balance due in April. If that is you, one option is voluntary withholding from Social Security using Form W-4V. Another possibility is making estimated tax payments during the year. The right choice depends on your overall tax situation, but the main point is simple. If you know the tax is coming, do not let it ambush you. This is especially important for seniors whose only withholding has historically come from wages, and then after retirement, there is no automatic withholding unless they set it up themselves. A lot of people get their first unpleasant surprise the year after they retire, not because the law changed, but because nobody warned them how the cash flow timing changes. Check number 5. Remember that the threshold rules are old, but your income sources may be new. This is one of the reasons the tax on Social Security catches so many people. The thresholds are not indexed the way many other tax numbers are. Meanwhile, retirees today often have more moving pieces than they expect. A pension, part-time work, brokerage income, IRA withdrawals, and Social Security can all coexist. That mix can make a middle-class retiree feel like they are being treated as a high-income taxpayer, when in reality they are simply piecing together retirement cash flow from several ordinary sources. And because of that, seniors should not use outdated assumptions. Maybe 10 years ago, your benefits were not taxable. That does not guarantee the same outcome now. If your spouse died, if you started required withdrawals, if you sold property, if you changed filing status, or if you returned to work, your tax picture may be very different today. Check number 6, do not forget state taxes. Most of the conversation focuses on federal tax, and rightly so, because that is where the up to 85% rule comes from. But some states also tax Social Security or have their own retirement income rules. Fewer states do this than in the past, but if you live in a state that still taxes retirement income, you need to understand the combined effect. Some retirees focus only on federal withholding and still end up surprised at the state level. Now let us talk strategy in plain English. If your combined income is nowhere near the thresholds, your job is simple: keep good records and recheck every year. If your combined income is close to the thresholds, your job is to be more careful with large withdrawals, one-time income events, and major tax decisions. If your combined income is already well over the thresholds, your job is to plan for the tax, not pretend it is not there. And if you are getting hit because of big IRA withdrawals or other retirement distributions, it may be time to talk with a qualified tax professional about your withdrawal strategy, Roth conversions, timing of capital gains, or other planning tools. I am not telling you there is a magic way to erase the tax. I am telling you there may be smarter ways to manage when and how income shows up. Here are a few common situations. Situation 1, you are single, you receive Social Security, and you also work part-time. Your wages alone may push you into the zone where up to 50% or up to 85% of your benefits become taxable. That does not mean part-time work is a mistake. It simply means you should know the tax consequence before you spend the extra money. Situation 2, you are married, both spouses collect Social Security, and one of you takes a large IRA withdrawal. That single withdrawal can change the tax treatment of a large share of your household benefits. Again, not necessarily a reason to avoid the withdrawal, but definitely a reason to plan it. Situation 3. You are widowed. Filing status changes, household income changes, and the tax picture can become less forgiving. This is one of the most overlooked retirement tax transitions. Situation 4. You receive tax-exempt interest from municipal bonds and assume it does not matter. For this purpose, it can matter because tax-exempt interest is part of the combined income formula. That is why I keep saying the same thing. Do not guess. Check the number. Your Social Security statement tells you what you received. Your tax return tells you what other income you have. Put the pieces together early. So let us summarize the 6 key checks. Number 1, estimate your combined income before tax season ends. Number 2, remember that 85% taxable is not the same as an 85% tax rate. Number 3, identify the income sources pushing you over the threshold. Wages, IRA withdrawals, pension income, capital gains, rental income, or tax-exempt interest. Number 4, consider voluntary withholding or estimated payments if you know a tax bill is coming. Number 5, do not rely on what was true years ago. A change in retirement income can change the taxability of benefits. Number 6, review state tax treatment as well as federal rules. The reason this matters so much is simple. Social Security is supposed to be a stable foundation in retirement. But if you do not understand how the tax rules work, that stable foundation can suddenly feel shaky. And the worst time to learn about that problem is after the IRS bill arrives. If this video helped you, subscribe and share it with someone on Social Security. A spouse, a parent, a neighbor, or a friend may be one tax estimate away from avoiding a costly surprise. I will see you in the next video.